Okay, let's talk about one little word on every insurance policy that trips people up but can actually save you a ton of money. Excess. What on earth is it? Well, stick with me because by the end of this, you'll know exactly how it works and more importantly, how to make it work for you. You've totally been there, right? You're looking at insurance quotes, everything's making sense, and then bam, you see this word excess with a dollar amount next to it. Is it some kind of hidden fee? A penalty? It really feels like they're trying to confuse you, but honestly, the idea behind it is super simple. All right, so first up, let's just rip the Band-Aid off. Let's get a simple, no-nonsense definition for what excess actually is. And there you have it. Your excess is just the amount of money you agree to pay out of your own pocket if you make a claim. Think of it as your share of the cost. The key thing to get is that it's the part you cover before your insurance company steps in and pays the rest. You pay first, then they take over. Here is probably the best way to think about it. It's kind of like a copayment when you go to the doctor. You know how you pay that small fixed amount up front and your insurance handles the rest of the bill? Well, your insurance excess is exactly the same thing. It's basically your copay on an insurance claim. Okay, so a definition is one thing, but seeing how it works in the real world is what really makes it all click. So let's walk through a quick example. Let's imagine something that unfortunately happens all the time. Your laptop, which is worth, say, $2,500, gets stolen. Bummer. But hey, you're insured, so you're going to make a claim. Now, when you look at your policy, it says you have a $500 excess. Just lock that number in your head because it's the most important piece of this puzzle. So how does the payout actually happen? It's pretty straightforward. First, you're on the hook for that first $500. That's your excess. Once you've covered that, the insurance company jumps in and pays the other $2,000. So in the end, you get your laptop replaced and your total out-of-pocket cost was just that $500 excess. Simple, right? Okay, so now that we get what it is, let's talk about the really important part, why this little number matters so much when you're actually buying a policy. It all comes down to this big trade-off between your premium and your excess. This right here is the golden rule you absolutely need to remember. They work in opposite ways. If you're willing to take on a bit more of the risk yourself, by agreeing to a higher excess, the insurance company rewards you with a lower yearly bill. That's your premium. It's basically their way of saying, hey, thanks for handling the small stuff yourself. Let's just lay it all out. If you choose a lower excess, yeah, your annual premium is going to be higher. But the good news is, if you ever have to make a claim, what you pay out of pocket is pretty small. Now, on the flip side, if you go for a higher excess, you get that awesome lower premium every year. But you have to be prepared to pay a bigger chunk of money if something actually goes wrong. And we're not talking about just a few bucks here and there. The savings can be huge. By choosing a higher excess, you could slash your annual premium by 20, maybe even 30%. I mean, that's a serious amount of cash back in your pocket each year. All right, so this all leads us to the million-dollar question, right? We get the trade-off. Now, how do you make the smart choice for your bank account? So, which one is it going to be? What excess level is actually right for you? Look, this is a totally personal decision. There's no one-size-fits-all answer. It really comes down to how comfortable you are with risk and, probably most importantly, what your savings look like. Okay, so here's a really simple way to think about it. You should probably choose a low excess if a surprise bill of, say, $1,000 or more would completely drain your emergency savings. Yeah, you'll pay more each year, but that's what peace of mind costs. But if you've got a healthy emergency fund and you could cover that cost without breaking a sweat, then choosing a high excess is a super savvy move to save that 20 to 30% every year. And that really brings us to the final, most important question you need to ask yourself. Just be honest. Could I write a check for my excess amount tomorrow without having a complete panic attack? Your answer to that question tells you everything. Let your emergency fund be your guide. And that, right there, is the smartest way to balance getting great protection without overpaying. Hopefully, this makes that choice a whole lot easier next time.